Hello YouTube. So today I'm going to be talking about the difference between price and value. So a lot of people know the price of everything but the value of nothing.
What?
So today I'm going to go into what exactly is price and what exactly is value and how you can use those two to actually make money in the stock market. So stay with me. I am a retail investor trying to help people out there to invest better and to prepare for their financial future and be financially independent when they retire. I'm going to be looking at the difference between price and value. So those two things, they sound almost like they are the same, but they are not. They are very different. And in long-term investing, the deeper understanding of what these two terms mean and understanding how to actually price and get the value of assets will mean the difference between the poor house and that Lamborghini. No, actually, this is not about Lamborghinis. This is about you being financially independent. What really is price? The definition of price is very simple. I don't want to make things complicated, and if you're a beginner, I want you to be able to understand and grasp things.
Nice.
So I'll keep it silly simple. So price is what someone is willing to pay.
Okay.
So price changes every second, especially on the stock market, based on supply and demand. And if you know a little bit about economics, you know that if the demand is quite high, the price goes up. If the supply is high, the price goes down. So a very good example is the tariff situation. Because of the uncertainty in the market, people started offloading their shares. And this actually resulted in supply going up. So once supply goes up, the price goes down. And this is what happened. Prices started to go down because people were uncertain. People didn't know what was going to happen. The effect of those tariffs on their stocks. So people were offloading, and that increase in supply caused a downtrend in the price. Let's also go into what value actually is. The value of a stock is the actual worth of a business based on its ability to bring up or bring out cash flows in the future. In simple terms, the value of a company or the value of a business is how much that business will pay you in the future. And we look at this from the perspective of cash flows or profits. So profits are what we start off with, and then we do some calculations to actually get the cash aspect in that profit. So those are what we call the free cash flows. These are cash payments that are made to the shareholders of that company. If you are going to be buying a house, you want to look at how much is this house going to pay me in terms of the rentals. If you're going to be buying a mine, you're going to be looking at how much is the mine going to pay me in terms of deposits that are actually extracted out of this mine. So that's in short my concept of value is how much the business is worth based on what it will pay you. So why does price and value often diverge? So in the market, when I was at university, we were taught that the market is efficient, and that hypothesis is not exactly true because the market is not efficient all the time. So it's efficient some of the time. What happens that causes price and value to be different is that sometimes you get news that comes up about certain stocks or certain shares, and the market overreacts to that news and punishes some stocks and they go down in value in a way that is not justified. So in this instance, you will find that the price will go below the actual value of that company. Price doesn't stay static, it doesn't stay the same, it changes every day. And this is what we call the Mr. Market scenario. The Mr. Market sometimes is euphoric, is over the moon, is on cloud 9, he's selling things to you at very inflated prices, PEs of over 100, PEs of over 200 sometimes. Things get crazy, especially in the tech stocks. And then sometimes the same Mr. Market comes back and is depressed. He's basically selling things to you for 10 cents on the dollar. The prices are down, the market is in a bear territory, things are just going down. And in this instance, this is where you find a lot of the bargains. So these bargains will be stocks that are selling at 30, 40, 50, sometimes even up to 80% below their intrinsic value. And that's what we call the margin of safety. And this is what I want my students to grasp, that you make money when you actually buy below that margin of safety. If you buy when the price is below that margin of safety, it's below value, it's below the value of the company, it's below the margin of safety. This is how we make money. So how do you act on these price differences? When you hold a stock and that stock, the price goes way above the value, that will be time to sell. And for me, I believe that whenever a stock is egregiously valued and you're holding it, it's time to sell. You have to be greedy when others are fearful, and you have to be fearful when others are greedy. So when the stock market is going up, that's when people are greedy. You have to be fearful. Do not be buying. That's a seller's market. That's a market that's providing opportunities to sell. And this is how we take advantage of the difference between price and value. So the final takeaway is that price is what you pay and value is what you get. So focus on the businesses, not just the stocks. Focus on the fundamentals of the business, not just how the stock is being talked about or being hyped up on social media. Focus more on what the stock is doing, what the stock will actually generate, and what the stock is actually going to make. So if you found this video useful, don't forget to follow, don't forget to subscribe. I will be dropping another video on how to start valuing stocks like a pro. So do follow me and share this video with your friend, uncle, aunt who wants to become financially independent and retire early. This is me signing out. Bye.